All right, can you guys see the red ball? Okay, the red highlighter. Okay, good. I'll go ahead and get started then. All right, this is the Tortoise Weekend Strategy Report Review for September 29th, 2013. We'll just get right into it. We've got a market that is bullish normal. On an annual basis, using the weekly RSI 14, we're at 62 out of 100, in the middle of neutral. On a 10-day basis, using the 10-day NDX, we're at 20 out of 100, which is right on the boundary between neutral and oversold. One more tick down, and then this would pull back into oversold conditions. So we're right on that boundary. Looking at elements of the market mosaic here, price relative to the 200-day moving average is still bullish at 6.6%, but it's yellow bullish, meaning that the pullbacks of this week have affected that little safety buffer, if you will. We're about 4.5% away from sideways conditions. The slope of the 50-day moving average is now red bearish at 0.05%, or basically flat. When that slope goes negative, it's not been a good thing for the market in the following days. So this has been under decay for a while now. ADX has dropped back down to 16.3 as the bears mounted a comeback this week after the Fed announcement. It's been pretty harsh selling, and I think recognition of this government shutdown is starting to affect the markets. So it's back to a non-trending reading at 16.3. ATR percentage is still actually remarkably quiet here at 0.77. It's still in normal conditions, but it's on the lower end of normal, almost towards quiet. The risk index, which is the 30-period moving average of the VIX divided by the 10-period moving average of the VIX, is at 1.06. Because that's greater than 1, that's in risk on condition. If we take that reading of 1.06 and look back 5,000 days and compute the standard deviation and then the z-score, gives us the risk z. That's at 0.63%. And on this chart, you can see the 90-day time series of that reading, and we are rolling over here got as high as almost 0.8, and has now started to decline the last couple of days. That's an increase in volatility. What's troubling here for the long side is the fact that it's rolling over just underneath 1 SD. A really quiet market would have continued all the way higher, and this rolling over is problematic. That gives us an alert about the potential of some sharp spikes ahead, and I think that could be triggered by these continued lack of negotiations in the government. Blended monthly rebalancing is currently holding these. We got a reevaluation that's due on or about 1 October, so that's Tuesday. So we'll take a look here in a second at the leading candidates as we speak. You'll see some of the globals coming up on that list. And I think that's a recognition of the market trying to shift a little bit away from shenanigans in the U.S. The ETF2 model is at 100% exposed. The model portfolio itself is 100% exposed. This week, all that happens is a couple stop losses are raised. The 1 week results of that trade in TAN, the solar ETF, is up 10%. So there's some reasons to pay attention to those reports for shorter than the monthly holdings. There's some swing trade opportunities that are appearing in there. All right, so moving on. First look at the 13 ETF portfolio. Now, if we had to execute that today, the symbols would be U.S. Technology, EFA, which is the Euro-Asia blend, and IWM, the Russell 2000. And now what I want you to just notice is that SPY, which had been at the top of the list there for 6 months, has moved down to the middle of the pack, and it's been eclipsed now by emerging markets, Australia, Asia less Japan, and the Euro-Asia blend. So that's a recognition, a shift away from those U.S. large caps. In the 32 ETF portfolio, you'll know it's the European 350 IEV. That's the equivalent of Europe's S&P 500, only it's their 350. FXI, the China index. EEB, which is Brazil, Russia, India, China. All three of those now are exceeding the U.S. leader, which was the Q. So 4 out of the top 5 are globals. Only the U.S. techs are in the mix. Still only a handful are on cash positions. But we're seeing a reorientation to the global posture right now. All right, so looking at the market health check, I want you to just notice the slope of the 30-day regression line. That's the oscillating wave that I'm tracking right now. Back in June, it got as low as minus 0.225, rolled over, crossed the zero line here in the 10th of July as the market recovered, got as high as 0.45 in the early August. Drop back down to the zero line, back down to that minus 0.225, reverse crossed above the zero line, and is now starting to stall a little bit here halfway back up the tree. It's at 0.275 right now. And so if that were to roll over here, that would be negative for the market. Because that would indicate, you're getting relatively lower highs in terms of strength of the market, that the upward trend lasted a shorter period of time than the previous one. Even though the price achieved a higher one, there was less endurance in there. The 90-period regression channel is the green line. The 30-period is the black lines. The 10-period are the blue lines. And you can see the 10 has started to roll over, while the 30 is still upward sloping. The 10 has already began to roll over again. We have to see price above about 173 to really think we got a resumption of the bull. That was this spike here from 170 to 173 was that immediate reaction to the Fed's not turning off the spigot. But since that time, we've had 1, 2, 3, 4, 5, 6, 7 days of steady decline, and closing weekly on Friday ahead of government shutdown. If the market fails here, and it's right near this Bollinger Band 50 or 30, the middle of the river, we'd be looking at 164. Really, so if it fails through 168, 167, then it gets down to 163 to test this bottom here. Which is outside of the river. And then right around 160 is where sideways market conditions take over. You can see in the ADX the decay of trendingness, and the bulls pulled way back, and now the bears have caught him. So this is a non-trending market, equally weighted between bullish and bearishness. Meanwhile, the 200-period moving average continues to just march northward, which is almost like a time stop here asking the market to make some decisions in here. But you can see that over the last 10, 20, 30, 40, 50, 60 days, we haven't really made any progress in this thing at all. We've had extended sideways, a pullback, a minor gain, a pullback, and we're almost where we were 60 days ago. So this is that's why that 50-day moving average is basically flat, and this could be seen as the beginning of a head and shoulders pattern, I guess, if you're a technician. We're just dipping into oversold conditions here on the Williams percent R10. Then you can see the jaws of PPO have opened to the downside. So this is a market that this is what a transition state can look like. It can very easily support failure here without that little spike in the Fed, and with increased political ineptitude in Washington. That's not going to be good for the economy. Then this could be seen as a local high watermark here at 173. And then again, the downside looking at 168, 167. If that fails, I think it's a quick rush down to 163. And then that puts the entire 90-period gains at risk, because that would be a violation of the 90-period regression channel. So this is looking increasingly problematic. Okay, moving on. Looking at the ETF2 report for the main indexes and the sector spiders. Let me let that come up on your screen. All 10 of the indexes are on buy conditions with respect to their 4-month moving average filter. And that keeps the model at 100% invested. The shift in power away from the U.S. has continued. Now you can see that it's EFA is still better than SPY. That's EFA at 56 compared to the S&P at 51. And IEV at 59 is the strongest of the sectors. So IEV at 59 and then U.S. small caps at 56 represent the strongest sectors. Latin America and emerging markets at 46 and 50 respectively are the two weakest sectors. Inside the U.S., it's the small caps at 56, large caps, tech at 56, then the mid caps, and then the large cap U.S. pulling up the rear. You can see how the mighty have fallen. S&P has now pulled back to really almost like the 9th position or 8th position here in the stack. Inside the U.S. sector spiders, still weakness in utilities and staples, and then strength in industrials and healthcare and consumer discretionary. So this is a shift in power away from the U.S. It continues this week. The world market model. For the first time in a long time, you've seen weakness appear inside the U.S. with yellow up here in large cap value. That's the Dow 30 Industrials. Only small cap growth in the green. Meanwhile, China and South Korea in the green. Australia, Hong Kong, Taiwan above average. Japan above average. Everything Europe solid. This is why that IEV play is working so well. Inside the global sectors, in every case, the global business sectors are winning, except in materials where it's a tie. And consumer discretionary is dominating in both the U.S. and in the globals. Weakening dollar here you can see in the stack of currencies. It's in the red. And only the British pound is showing extreme success here. There's some good candidates in here for potential swing trades on relative strength momentum. The Solar ETF 10, PGJ, the Golden Dragon Index from China, S&P Biotech Spain, Clean Energy Biotech European 50, Austria, the EMU index, European Monetary Union index, France. So you can see that the shift in power away from the U.S., away from the small caps even, to a more diversified global collection. Those that are green on strength and white in consistency are ones that ought to get your attention, because that's a sign of emerging strength. So like Italy at 64 in the green, and consistency is it's also in the white at 64, and it trades 1.3 million shares a day on average. So that should be of interest. The European 50 FEZ, it's liquid enough at 945,000 shares a day. The EMU index, looking good too. So those that are green, and then white in green in strength and white in consistency, are emerging leaders. China still has room to go with that GXC. You can see here is green on strength and white on consistency. Moving on. Next up is the Dow 30, using the same lens. And you may recall 3 months ago, this was mostly green and white as the U.S. large caps were dominating. And now you're starting to see more red. So the bottom of the stack, Verizon, IBM, Coke, AT&T, ExxonMobil. And these are relatively recent losers except for IBM, because you can see that they are red on strength and yellow on consistency. So this is, may even be shortable because of that relative strength imbalance. 3M is starting to decay a little bit too. So green on consistency, but now only white on strength. As is Travelers, white on strength, yellow on consistency. So this is really becoming a sign of weakness here among the U.S. large caps. But the strength leaders up here, Boeing, Nike, United Tech, DuPont, United Health, still all in the green. And that green is relative to the 1,500 ETFs in the database. So that's where they stand in terms of overall strength compared to the world market. Just some stats on ETF liquidity. We're going to shift now to the daily report. And I'll just highlight overreaction signal in diamonds, and then channeling signal in the spiders. You can see that the S&P volatility over the last 100 days has come down almost to the boundary of quiet. And so if we get some bad news, I mean, there's really room for a VIX spike. So we're going to take a look at the VXX here as an opportunity trades when we get to charts of interest. So I'm going to add VXX to my list, along with the diamonds, DIA, and SPY. Plenty of symbols to choose from in both the ETFs and the large caps concerning the channeling and overreaction. And that's a function of the market condition itself and how strong it is in all those large caps. Then we have 5-day downs in Goldman Sachs, Johnson & Johnson, and ExxonMobil. So we're going to take a look at those. That's one of my favorite patterns. Johnson & Johnson, ExxonMobil. And then 551W. I like those because that actually turned in a 1-day show of strength on Friday. So that's going to be UTX, 3M, and Visa. And then in the auto framer, these all test out better than 2-to-1, simply based on trade location. Caterpillar, Johnson & Johnson, ExxonMobil, Goldman Sachs. Silver is in that stack. The S&P itself, SPY, and Walmart. So those are some potential candidates. Given the pullback from this week, now that we're looking at the tactical, you can see just how many line up well on the auto framer. If you look at some like Goldman Sachs, has to be on your short list for swing and intraday candidates. I mean, it's number one max pain range compression. It's 5.5 to 1 on the auto framer. It's a 5-day down pattern. It's both channeling and overreaction. It has a 3.2 frog quality number with an 87 cents on the as the frog standard deviation, the frog box. It moves $3.50 a day on average. Right, no, 8 cents, about $2.50 on average, with a range stat of 0.3 or 3.6, and it has an RSI 2 value of 2. I mean, you have to be interested in that. And then these next three that are also highlighted: Caterpillar, Johnson & Johnson, ExxonMobil. Each one of them better than 5 to 1 on the reward to risk. They test out well on max pain range compression. They're 5-day downs. They're dojis. ExxonMobil and Johnson & Johnson were dojis on Friday, and Johnson & Johnson was a channeling and overreaction. I mean, there's a ton of things to be interested in there. And then you look down here, United Tech is a 2.1 on the auto framer and a 551W. Visa is a 3.5 to 1 on the auto framer and a 551W, so that's got to be of interest. More than half of the ETF 30 are on auto framer reward to risk signals as well. We'll let that come up on your screen. There we go. Oil, coal, the diamonds, the finance spider, the consumer staple spider are numbers 1 through 5 on the max pain range compression. Coal is also a single-digit signal on RSI 2. Quite a few dojis, quite a few channeling, a couple overreactions. There's 551Ws available in the spider itself, energy, and then the S&P industrials, which have been strong. That the fact that the S&P is at 4.6 to 1 on the auto framer is a 551W and closed with a doji is very significant. That's a really good trade location for it to be in there after a week of suffering. That's very well postured for a rebound. And the other side of it is that if it fails, it's going to fail sharply. So there's a really good short-term trade developing the S&P in either direction that puts it in a critical state, which is, to me, the ideal location for shorter-term trading, when you can see a very strong reward-to-risk ratio trade in either direction. Looking at the auto framer next, that just has the details of the various symbols, so I won't read those off to you, but that's some good reference points for you. And quite a few better than 2 to 1 reward to risk. Next up, some more charts from the market mosaic. You can see the slope of the 30-day regression line here in chart number 1. And then prices crossed back underneath it and ended in a doji, and the polynomial curve line has crossed the 30 as well. The fact that it ends in a doji shows real good potential for this week. That just says that people weren't willing to hold it over the weekend, but weren't in a panic to get out of their positions. The slope of this 30, you note these long ocean swells here in chart number 2. We're above the 6-month average, but running out of steam already at a lower high. We're already testing the strength of this bull before it ever even really got back up to 173. So that's kind of a negative in my view. And then the percent right below it, chart number 5, the percent stretch relative to the 200. Notice how on a standard deviation basis we got these declining highs after each little peak and increasing lows. And so if this thing were to follow through and fail, it should fail down to 2 standard deviations below, which is a loss of another 3 or 4%, which takes it down right to the edge of the sideways market, which gets it down around 163 in the S&P. That's the real consequence. That would be a $5 adverse move in the S&P, and that is certainly within the realm of the possible, just given this quick look here. You can see volatility is on the rise as measured by the standard deviation of price over the last 30 days. Using the ATR percentage, it has only stalled down here at the edge of quiet, and a sharp move up is certainly well within the range of normal. That makes the VIX a very good candidate. The rest of these are simply reference charts, which I will flash through to complete the record. And all I want to show you on this one is the slope of those regression lines that have been normalized by standard deviation. See, the 10 is at the bottom of its channel, so it could continue to fail for another 2 or 3 days. If it does that, if it were to get down here at -2 sigma, that would be a test of the bottom of the river and get it back around 163. That's well within the bounds of normal. The 30 especially is at the top of its channel and starting to stall, so that would support a rollover scenario. And then the 90 had pulled back to the Bollinger Band mean here, or the standard deviation mean, and just started to hook back up. So there's nothing compelling in that to give it long-term strength. A tactical pullback of 3 to 4% is certainly well within the bounds of normal. This is a very good trader's market right now. All right, so we're going to shift to charts of interest now. Let me get that set up for you. Hold on. Still fighting my way through the slow connector for you. There we go. Yeah, CLF, we'll take a look at that one here in a minute. This is what I just wanted to show. We got SPY on the chart right now. And this was that 30-period regression line last week. Is now shifted back because of the gains from the response to the Fed, but you can see how it's kind of passed through. The dragon is now approaching the Bollinger Band mean. And so in terms of the S&P, with price right here, a target back to the Bollinger Band mean is certainly in order. This 164-ish, this is what that 3 or 4% fail looks like. It's a price getting down to this level. And then really we got to be thinking about support at 163. Both of those are really crucial. So the bottom of the river is certainly a target. The Bollinger Band mean is a target. And then it's got to hold support here around the 163 mark, or it's look out below. On the upside, this is good because what we have here is it was a doji action on Friday with a slightly up higher close than an open. And then really gets through the top of the dragon, all the way up to the edge of the floodplain, and then it's still got to get above this 173.5 for it really to take off. But this represents a nice upside tactical trade reward that's available. Yeah, Chip, my screen here is showing that that you have a chart available. Let's oh, I see. Let me try it again. Hold on. All right, stand by. I'm trying to get that restarted, and I'll cover those comments again. Still working. Looks like GoToWebinar is frozen. What I'm going to do, I'm getting ready to sing happy birthday to my daughter here in about 5 minutes anyway. Got people starting to load up in the house. So here's what I'm going to do is I'm going to record a separate session on the charts of interest. I've got about half a dozen charts that I'm interested in here. Cliff, VIX, the S&P, Diamonds, Goldman Sachs, and all that. So I'm going to record a separate video just on that, and I'm going to hang trade frames in the chat room for members. So I'm going to go ahead and call it here. I get a 15-year-old daughter that needs me to hear her, needs me to sing to her. So we'll get that done. Hey, thanks for your attention tonight, and I will follow up with the charts. So take good care, guys, and we'll see you in the chat room.